chance here in the coming months to meet her as well. As always, we are happy to help you with any hiring needs. As most of you know, we do both permanent placement and we have consulting practice. So depending on what time of year it is, different accounting and finance needs that you might have. We do help on the HR side. We do quite a bit on the ERP implementation side through our consulting practice. But then, as many of you know, our other big division is in life science, so all the scientific skill set. So if you happen to work for one of the life science companies and you're struggling with some of those skill sets, then we'd be happy to help you as well. Okay, that was it. That was the commercial. So today we will actually have 4 polling questions. I just need you to answer 3 of the 4 in order to get the credit. As always, if you're having any issues with your polling questions, just direct message me and I will jot your name down. If you do have questions as we go through for Ted, drop them in the chat and I will try to watch the chat and just make any comments, throughout the presentation. And then I think we probably will have a few minutes at the end if there's Q&A, but I know that Ted does like, kind of interactive, interactive session. So to the point that we are able to do that, feel free to do that. So many of you were with us a few months ago when Ted did a presentation. The world is changing very, very quickly on us. And so we thought it might be appropriate to just kind of get a little update and a little bit of feedback. He and I were talking beforehand, obviously today at 2 o'clock, there'll be an announcement from the Fed. And so I think that will probably, change some ideas and predictions as well. But without further ado, I will turn it over. And Ted, anything, I know you introduced yourself last time, but any other things you want to introduce yourself? And I just want to say when we launch a polling question, either Michaela or I will come back, so you'll hear a different voice. So just be listening for one of us calling you back from the kitchen to hit those polling questions. So Ted, I will turn it over to you. Tell us what is going on in this crazy market.
Thank you, Crystal. Can you hear me okay?
Yes.
Excellent. So my commercial is also a disclosure. So 2 types of disclosure. We're going to talk a lot about economics today. That's the topic of the day, but I'm not an economist. By trade, I run a financial planning and asset management firm. So we look at all of this stuff that we're going to be looking at to help guide and shape some of the decisions that we make when we're managing client assets. So that's what we do. It's Hicks Associates. That's my firm. To connect with me, there's my contact QR code. I tried to get fancy and learn how to use a QR code. So it's got all my contact, Twitter and LinkedIn, and also has our YouTube channel. And so if you have not subscribed to our YouTube channel, we do try to post usually weekly video content. Once a month, I go into a little bit more depth. And Krista was telling me earlier that she anticipates my monthly market monologues almost as much as Yellowstone. So you can check that out. And then the other disclosure is, I think, Michaela, correct me if I'm wrong, but I think on the title of this presentation, I said, could all of the pundits be wrong? That was like the subtitle of our presentation. So this is the disclosure slide that my compliance makes me put up to let you know that, well, what if Ted's wrong? No, that's the disclosure. So first, we're going to talk about the banking crisis. We're not going to go into a ton of depth because if you've been watching the news, you've probably gotten bored of the topic to some extent with just a little bit of anxiety. And so we know that just a week or 2 ago, Silicon Valley Bank collapsed. And the big reason that they collapsed is in their risk management. What banks do is when you put money into a bank, that is now, that's your asset, but it is their liability. And they then will determine how much of those assets, the cash that they want to invest. And so frequently, they're going to use treasury bills and treasury bonds and treasury notes and things of this nature, because modern portfolio theory teaches, or I would say preaches, that treasuries are quote unquote safe. And so if you want a safe asset or safe investment, you use treasuries. Well, Last year, treasuries were down about 30%. Okay, so on the screen right now is the TLT ETF, which is the iShares 20-year bond ETF. And I think I've got the return on there every year since like 2005 or something. 2004 is on the screen. And the big bold maroon line, that's last year with a negative 30%. That's really what sparked everything and the problems for Silicon Valley Bank. Now, here comes our first polling question. So get your thinking caps on. And we know that Credit Suisse has also had some problems. And so the question is, was the problems at Credit Suisse a major surprise or not really a surprise at all? And I'm seeing the answers, and this is a smart bunch.
Okay, first polling question, everybody.
It is. Participation looks good. We're waiting on one person.
One person, okay.
Where are you?
Excellent.
4 polling questions today, but if you get the first 3, it'll make life easier.
Yeah.
Absolutely. We'll
So it looks like 100%
a few
answer.
seconds. Oh, there we go. We do have 100%. Fantastic.
All right. So B is the correct answer. Credit Suisse has had some problems for quite some time, and the answers are all on their stock chart. This is the global financial crisis of 2008. Obviously, a lot of banks struggled during that time period, but a lot of banks recovered. Credit Suisse has never really recovered. And so to some extent, the problems that they're facing right now, it's not a surprise at all. It was just inevitable at some point. So that's all we're going to get into for now on the banking crisis. Let's switch gears and talk about the economy. And this is what you're going to see is this is where I got the title for our presentation from, because I'm going to highlight this date down here. This is from Bloomberg. This is October 17th. Remember that date? Well, you should all know that date. That's my birthday. So, I mean, let the presents come in on that day. Anyway, October 17th, Bloomberg forecast, they said that there's a 100% chance that we're going to see a recession in 2023. Well, it seems fair that I would point out that this date right here is October 13th. So far, the low in the stock market of the current cycle was October 13th, and Bloomberg prints that proclamation just 2 market days later right here. And they say it's a 100% chance that we're going to see a recession in 2023. Not too long ago, or not too long after that, about 2 months, they changed it to it's a 70% chance that we're going to see a recession. This is from Bankrate. This is on January 4th. Now we're at a 64% chance. So what you're trying to show is just the comments and the projections are starting to come down that we're going to see a recession. So I want not to belabor the point. You get the idea. There's been a large number of professional prognosticators who have been declaring that we're going to see a recession in 2023. So here is our consensus. The consensus outlook for real GDP growth in 2023 is 0.3%. Okay, that was printed in December 5 by the Federal Reserve. So here's our next polling question. Which of the following 2 groups are leading economic indicators? Really hope everybody gets this one right.
Sorry, oh, that's funny. That's good stuff. Okay, polling question number 2 is on the screen. We got 2 of them quick early on in the presentation. So make sure you hit that.
I think we had a couple, 1 or 2 people who joined a little bit late. So the good news is there are 4 polling questions today. So if you missed the very first one, as long as you get this one and the next 2, you are still covered for credit.
Looks like we got 100% answered.
And it looks good.
So obviously the answer is B. And so that's what we're going to do is we're going to look at these leading economic indicators as well as some other ones. On the screen now is I shouldn't say it's the yield curve. This is one of many different yield curves. And ultimately what we're looking at is a 10-year yield minus the 3-month yield. Now, the reason I use this one is because Dr. Campbell Harvey, he's a professor over at Duke University. He wrote his thesis in 1982 or 1980. I don't remember what year it was, long time ago. But he wrote his thesis and is arguably the one that identified the fact that the yield curve inversions predict a recession. And his paper is on the 10 and 3 month yield curve. And that's what he's on LinkedIn, so you can follow him if you want. So he talks a lot about this, and the inversion is when this math goes negative. So here's this zero line, and you can see these gray bars. Those are the official recessions as denoted by the National Bureau of Economic Research. And so you can see we went negative, then there's a recession. We went negative, there's a recession. We went negative, there's a small minor recession. Here we have been very negative, and what I really want to point out is we've never been that as much negative as we are right now on this particular yield curve. Some of the other yield curves, like the 10-year minus the 2-month yield curve, that is becoming uninverted, but the 10-year minus the 3-month is not yet. And again, this is just zoomed in. So we're showing that this is indeed inverted. And in the spirit of March Madness, we're going to keep a scoreboard. So far, we have the yield curve, and I would say it is indeed showing us that it is recessionary. Now we have durable goods. Durable goods, has durable goods come down? Yes, the durable goods indicators have indeed come down, but I would not declare that recessionary just yet. And we're going to burn through a lot of these fairly quickly. If I can get my mouse to work. There we go. So durable goods, not yet recessionary. Now we have building permits. Okay. So is this recessionary? Well, the building permit process, yes, this was very recessionary, but look at what the latest data is. It is stabilized and it is recovering. So I'm declaring that was recessionary, but it's not right now. Housing starts, basically the same data. I'm not going to put that on the scoreboard. It's a similar set of data, but it's the same thing. You did see a sharp drop off in housing starts, but it is beginning to recover. And so I'll put that in that same camp. So here we are, manufacturing orders. And I remember reading a headline, and this is where, Crystal, we can talk about what you and I were discussing before everybody hopped on, the news headlines. There was a news headline not too long ago that said something about manufacturing orders are coming in. And the implication was, hey, recession. Well, has manufacturing orders come down? Yes. Is that recessionary? I don't think so. That's natural ebbs and flows. And we'll come back to that point. So I'm saying manufacturing orders are not yet recessionary. Now, the next bullet point or the next leading economic indicator is the stock market. Okay. And this is why the stock market is what, because we manage money for a living, that's what our firm does. This is arguably the leading economic indicator that we rely on the most, because the stock market is a discount mechanism. It's forecasting what's going to be happening. And so we see this low in October, and it was recovering. It came back in, it recovered and created a new short-term high. It's come back and had a little bit of a correction, and it is again moving higher. So I would say this is also not recessionary. This is just me zooming in a little bit so we can see this correction was a decline of about 8% from this high down to that low. But I want to simplify it a little bit further by showing you this. When the stock market is in a downtrend, that's recessionary. Okay. When the stock market is in an uptrend, that's not. So what's a downtrend? Well, when we have a series of lower highs and lower lows, that's in a downtrend. Well, the opposite is also true. When we have a series of higher lows and higher highs, that's an uptrend. So is it choppy? Yes, but the stock market does not move up in nice, easy, smooth fashion. Otherwise, it'd make my job really, really easy. But that's the point, is this is arguably still in an uptrend. It's choppy. It's not necessarily fun, but that's what's going on. Now, today, as Crystal, you pointed out a minute ago, Chairman Powell and the Federal Open Market Committee is indeed going to announce whether or not they're going to lower rates or raise rates, pause their hiking cycle. They'll say that at 2 o'clock. On Fed rate day, the stock market it's a big yawn fest. And there's like nothing happening usually until 2 o'clock. And then at 2 o'clock, I frequently change my stock charts to a 5-minute bar. And it just, the swings right as at 2 o'clock happens. It's kind of phenomenal to watch it out, to watching that, how it plays out. So is the stock market showing us that a recession is coming? I'm saying no. If we take out the recent lows, then yeah, we can argue that it's forecasting a recession. But right now, no, it's not. Consumer sentiment is the next one. This is the famous consumer sentiment survey. It's done by the University of Michigan. And this black line that I'm showing here, I'm highlighting the fact that recently consumer sentiment was actually lower than it was in 1980. Okay, you can see that on the left-hand side of the chart over here. It has since come off of that low. Now, this data, one of the problems with this survey is it's a little stale. It takes a little while. So the latest research I've seen is that this is indeed going to come back down. The question is how much. So I'm saying for this one, I put it on my scoreboard. It was recessionary. Maybe it will be again when they release their latest data. So I'll put it in that column. Next, we have the financial credit conditions credit subindex. This measures credit risk. This is done by the Chicago Fed. And you can see on the chart, again, the gray bars represents the recessions. And when the figures are rising, when they're above zero, that's when credit is tightening. And that implies a tightening of the economic cycle and usually before a recession. Well, where are we at right now? Right now, we're below the zero line. And this data is actually stale. This was the Chicago Fed released an update this morning. This is more negative than it is right now. So this is also not recessionary. So put that on our scoreboard. Next, we're going to talk about unemployment. And Crystal, this is what you were talking about a little while ago that, what was it? You were quoting Amazon is laying off thousands of workers, whatever. So we'll look at continued unemployment claims. Has it increased? Yes. Is this alarming? In my opinion, not yet. That's the continued unemployment claims. But what about initial unemployment claims? Well, there's an initial unemployment claims. Did you even notice the chart moved? It's not recessionary. Well, unemployment. This is the national unemployment rate. This is where we're at right now, 3.6. And then most of us are here in North Carolina. There may be some outside of North Carolina, but I know most of us are in North Carolina here. We're at 3.8. These are not recessionary figures. So unemployment is still not telling us anything. Job openings. Has the number of job openings come down? Yes. You saw that come down. It corrected back up. Is this recessionary? I don't think so. But here's what you were talking about, Crystal. Layoffs. Have layoffs increased? Yeah. But if we look at that data series, we're at the bottom of the prior decade-long range. So,
well, and to that point, I'll just jump in real quick.
Please.
What we're seeing on our side, again, like I was telling Ted before the presentation started, there is a very different in the layoffs in the professional workforce as opposed to in manufacturing or in your hourly. So again, back to the Amazon example, when they lay off 15,000 people, that is not their professional staff. Those are hourly people working in their warehouses. Oftentimes, and to this chart, people have 2 or 3 jobs right now because they have a job and maybe 1 or 2 side hustles. I know this because my neighbor's daughter is one of the ones that got laid off from Amazon. So, you kind of have to take some of these things and understand, the components that are going into the graph. So when you look at layoffs, but I can tell you, at least in Raleigh, and, we try to keep our finger on the pulse of this, we are not seeing professional layoffs. Now, I've heard of a few little blips around town, mostly top grading, if you ask my opinion, because they'll do this and then they'll call us, the next week and say, oh, hey, I need a person, back in this role. So not seeing huge numbers in those layoffs. But again, you realizing, people often have 2 or 3 jobs now. So that the data makes sense to me as well, when you're looking at the unemployment numbers, because oftentimes you're not going to claim unemployment if you still have those couple of other jobs on the side.
So there's two things I'll add to that before we move on. One is I'll probably get it wrong. Somebody can tell me if I say Greek and it's supposed to be Latin, then let me know. But the word data, I think it's from the Greek. The root of the word is gift, right? So datum, I think the root word of that is gift. And so if you look at data correctly, it's a gift. The challenge is that, you know, when the news media, I think I shared this with you ladies before we let everybody in, I've kind of joked over the years that if the news media ever diversified their business interests and they got into the manufacturing of elevators, the up and down arrow buttons would change. It's no longer up and down, it's skyrocket and plummet. Now, the speed of the elevator wouldn't change. They would just label it differently. And so again, layouts are increasing. Therefore, no, look at the data. The data doesn't, that's not what this data is saying. So again, this to me is not recessionary. All right, Dr. Copper. Dr. Copper is sometimes, we call him Dr. Copper because the price of copper does a relatively good job of forecasting whether or not we're going to see a recession, because copper is used in so many different manufacturing processes. So Dr. Copper, it's because, well, Copper has a PhD in economics. That's why it's called Dr. Copper. So what we can see here is that copper prices have come down a little bit. I'm just zooming in here. So again, prices corrected, they recovered, and they're correcting again. I would indeed put this one in the category of recessionary. Okay. Now, this next chart is household obligations. This is measuring arguably the debt obligations for the average household, but there's a lot in this. And I remember several years ago when somebody was claiming, and again, a news article was like, household obligations ratio is rising, therefore calamity is on its way. Well, you know, at the time, the measure was like down here, and it's like it's never been lower than what it was. Is it? Well, other than last month. So again, this is not a concern just yet. When we look at it and we parse it out by just credit card debt, this is a little bit concerning, okay? Now, again, where the level is not a concern to me, because this is where we were at before the pandemic started. The challenge that I would have with this data is the rate of change. We've gone from this level, low level here, back to the pre-pandemic level very quickly. That, I would say, is a concern. But so far, people are doing a relatively good job of keeping up with their credit card payments. This is the delinquency rate. And again, the level is not a concern because that's about the level of this cycle low here. The challenge I would have would be in the rate of change. So the question is going to be whether or not this stabilizes. So the other thing that we talked about, or I put in my title of my talk, was about the debt crisis, that it might finally be coming to a head. So let's talk a little bit about this, because this is a big challenge. And this is right now, this is what we're looking at, is the total federal debt as a percentage of gross domestic product. And again, we can see that we have come down, but again, this is a percentage of GDP. So our total federal debt is more than 120% of GDP. That is not healthy, okay? And historically, if you do your history and you study this, the nation goes into debt to solve a crisis. Usually it's a war. The nation went into debt to fight the Revolutionary War. And then if you've never read on Alexander Hamilton, a fascinating story about what he did, because there were some that were arguing that the new United States of America should just abandon the debt that we built up fighting the Revolutionary War. And Alexander Hamilton famously was like, that's not the right thing to do. I won't get into that. But the point is, after the crisis passes, the nation works to pay down that debt. Well, then we have the Civil War. We go into debt, then we pay it down. Then we have World War I, and we pay it down. World War II, and we pay it down. So 1980, you remember Ronald Reagan and all the positive things that he did, but he also dramatically increased the defense spending. And unfortunately, good news is we won the Cold War. The bad news is we have not gone in and tried to pay this down. We started to make some progress in the dot-com era. There was Alan Greenspan actually talks about this in, I think, one of his first books, that the Federal Open Market Committee was actually having conversations about what do we do if we pay off all of the national debt. They didn't talk about that for very long because the problem went away and we started racking up debt again. So this is a very big problem long term, and this is why. So this is one of the technicians that I follow on Twitter. If you're on Twitter, he's a great technician to follow. And he says, the interest expense on U.S. public debt rose to $783 billion over the past year. It's a record high in Social Security and Medicare crisis. So we've known this crisis is coming for a very long time. There's actually evidence to suggest that even FDR, who signed the law putting Social Security Act in force, we knew this was going to be a problem. Well, according to the Congressional Budget Office, the Social Security Trust Fund will run out. Well, it'll be exhausted in 2032. Now, that sounds like a long time away, but that's 9 years from now. Here's the tidbit that I'm convinced most people do not know. If the Social Security Trust Fund runs out of money, there's going to be an automatic 25% cut to benefits across the board. I'm pretty confident your average Social Security recipient does not know that that is 9 years into the future. That is not that far away. So this, to me, is the budget crisis that is, or the debt crisis that is finally coming to bear, that hopefully we have some level heads in Washington. And it's not going to be one political party. All the geniuses in DC are going to have to put their heads together and come up with some compromises to make some changes, because this is a big problem. And of course, as the interest rates continue to rise, it causes those debt payments on our national debt to be greater. That's the problem. Good news is Treasury Secretary Yellen was recently talking about how when a country's debt load reaches a certain level, it really makes it unsustainable. So it's good that Treasury Secretary Yellen is aware of that. The bad news is she was talking about Zambia, not our own problems here in the country. So we'll see what happens. Now, here's the other concern that I would have, and I don't want to get too deep in the weeds on this. And we have our next question is, our next polling question is our next slide. So this is the amount of federal debt held by international investors. Mainly it's nations. China would certainly be a big holder of our national debt. Well, the point here is that you can see that it's come down a little bit. Well, China holds, I don't know how much, but they hold a ton of our debt. Well, Secretary Yellen has been warning China of quote unquote serious consequences if they help Russia avoid US sanctions. Well, if we rattle that cage too much, China could get back at us very easily by dumping US treasuries and selling their US treasuries on the open market. And that would cause a lot of havoc here in our own nation. Now, it is certainly true that it would cause some problems in China as well. But if they did that, that would be a really big crisis. So that is one of the concerns that I have, but it's also one that we can't do a whole heck of a lot. Now, speaking of all of this debt, the current administration has recently proposed a budget that includes tax increases. So here's our polling question. What is the highest income tax rate in U.S. history? Can you put that polling question up?
We're having a little technical difficulties.
Okay.
All right, so I'm trying to get
put some answers in the chat. Can
Yeah.
you see some answers in the chat?
Yeah, that will be just fine. Does everybody mind? Just drop. Well, I'm sorry, you're going to have to read the question out.
Okay, no worries. What's the highest income tax rate in U.S. history?
Okay, everybody just drop it in the chat and I'll get attendance there.
Okay. So far, we got one that's close. I got two people tied for the closest so far. Ooh, Thomas, you're now in the lead, Thomas.
Okay, a few more, guys. Everybody drop an answer into the chat and we'll
Can
get
you s-
attendance there while we work out our technical difficulties.
There we go. It makes it a lot easier when you get the multiple choice. Now the answers are coming in. We had a couple more folks answer that polling question. I think we got everybody though with the answers in the chat.
Yeah, I think so. I think we can move on, and
Fair
if
enough.
anybody's still wanting to, just drop a note there.
So we had two people suggest that 90% was our highest tax rate in U.S. history. Thomas got a little closer. He suggested it was 91. Answer is, of course, 94. Now, that was in 1945, if memory serves me correctly, and you had to be making $200,000 at the time. Keep in mind, our taxes are progressive. So the more money you make, the higher your marginal tax rate goes up. But believe it or not, we did once upon a time have a marginal tax rate of 94%. So let me explain what this chart is. This is one of my favorite charts, but it's got a lot of data on it. On the left-hand axis is the current or the highest income tax rate. So right now, the highest income tax rate is 37%. Okay. But if you go back on the left-hand side, here it is right here. The highest income tax rate was once upon a time at 94%. Now, the black line represents the percentage of the federal receipts, federal income. In other words, the dollars that are coming into the federal treasury from taxes as a percentage of gross domestic product. That's what the black line is. And the red line is, I believe I did a 12-month or 12-year average. Okay. So you got to wait for some years to actually populate. But you can see that that red line is fairly stable. On average, we generate about 16% of GDP is our revenue. My point of showing you what I'm trying to get across is it doesn't matter what the tax rate is. We're still going to get approximately 16% of GDP is going to be our federal receipts. So if we raise taxes, is it going to increase revenue to the government? Not really. Not as a percentage of GDP. And so what I would advocate, not that any of the current or past administrations have called for my opinion, but I would certainly advocate that we focus on doing things that will help stimulate the economy, not, changing tax rates, because it does very, very little. I would, however, suggest that we cut spending. That's a different conversation. All right, so we'll start talking a little bit about some of the projections for this particular year. Last year, we had first quarter and second quarter GDP was negative. Now, you might recall that the folks of the National Bureau of Economic Research have so far not stated that last year was a recession. And one of the things I said in last year's presentation was that the classic definition of a recession is when we have two consecutive quarters of negative GDP. Well, we had that last year, negative first quarter, negative second quarter, but the pundits then changed the answer and said, well, it's really when we have 2 quarters of significantly negative GDP. All right, I'll remember you said that.
Okay, Ted, quick question from Paul.
Okay.
On your last slide, why were net receipts so low before that period?
Before what period?
I think on your prior slide.
So the red line is 6% in the 1940s.
So why is it down here to start off with?
Right.
Yeah, I'm not 100% sure why. But what I'm trying to show is as we've leveled out as the data series, because again, this data only goes back to the 1930s. So we don't go back that much further. So at some point it's leveling out. And why is it that low?
Do you know if that's when, do you know if that's when the, let's see, so that would have been when the New Deal was going in. So Medicare, Medicaid, and payroll taxes go in. So maybe that's what sort of just those programs just take up that section.
It's possible. It's possible. Yeah, I'm not.
And the lower rates, the lower marginal tax brackets maybe didn't exist before the 30s. I'm just speculating here, but I'm going to your point that the tax rate doesn't matter, and I'm trying to understand it. It seems a little weird. So I'm just trying
I have buried in the bowels of my files a breakdown of all the federal brackets going all the way back. And if you want, send me an email. I'll send it to you. It's not that fascinating, but I'm happy to share it with you.
No. I was just trying to understand the graph here, but very good. Thank you.
The main, no problem, Paul. Good question. The main point that I'm trying to show is that the marginal tax rate, to Mark's point, it's not the overall rate. You are correct, Mark. This is the top marginal tax rate. And so the argument is that when politicians start talking about raising taxes, they're usually talking about raising the tax brackets. The other thing we like to point out in this is President Reagan made a comment one time that was very Yogi Berra-ish. You know, Yogi Berra was famous for saying crazy things like baseball is 90% mental, the other 50% is physical. It's like, wait a minute. So Yogi Berra said things like that. Well, President Reagan made some comment sometime, and he said something like, we are going to raise revenue to the government by cutting taxes. Like, wait a minute. How are you going to cut taxes and raise revenue? Well, that's what he did. I think that principle is called the velocity of money, but I'm not 100% sure, but that's been tried and done multiple times. And that's not what I'm advocating for. All I'm showing right now is that if we raise taxes, it's not going to fix anything, because there is a balance. We have to have taxes in order to pay things. But most people that I poll when I'm talking to clients, when we talk about how can we balance the budget or how can we get rid of, pay down the debts, it's got to be a balance of taxes and spending cuts. But all I'm trying to show here is when we start talking about raising taxes, especially the top tax bracket, it doesn't do anything. Anyway, good question. So moving on, we talked about that. We're going to look at the Federal Reserve Bank is, again, they were showing that a high percentage of professional forecasters were calling for a recession this particular year. But let's look at the actual data. This is what we're looking at. Okay. So now we're starting to see these are not negative numbers. So these forecasters from the Fed, they're not forecasting negative numbers. They're not robust numbers. Okay. And then there's your annual projection for the year of 0.7. Now, there's also a tool that I like to look at. This is the Atlanta Fed. Remember, the Fed is not just one bank, it's multiple banks. I think it's 12 banks, if memory serves me correctly. So this is the Atlanta Fed. They have a tool that they call the GDP Now. And the concept of this is instead of waiting for the GDP report to be released after the quarter closes, they're trying to give a forecast of what they think it's going to be, what it's going to be based upon the data that they're getting as the quarter goes by. Well, what they're showing is they're anticipating the first quarter GDP to be positive 3.2. That's not recessionary. Okay. So this, I don't use this index a lot. This is a leading economic index. And again, you can see that there was a slight downtrend to this data, but we've broken out of that. This is expansionary, not recessionary. So here's your next polling question. Do we have our tech working?
Yeah, I think we do. Michaela, see if you can launch it.
So the historical performance, in other words, the accuracy of the blue chip survey of professional forecasters is what? of our smart group.
Michaela, will it launch?
Yeah, it's launched.
Okay,
It's
thanks. She
87.
logged in as me, so I can't see it the same way any longer. All right, fantastic. So this is polling question number 4.
Yep.
So this is the last polling question. So everybody make sure that you do get this one. So we get the 3 out of the 4 registered for you today.
We got 3 more people that need to respond.
Yeah, just a couple people. We'll give you 10 more seconds.
Can I go back? So again,
All right. I'm going to go ahead and end the poll and we'll share results.
okay. So here's the answer. Less than 50%. And again, the consensus outlook for real GDP growth in 2023, 0.3%, second weakest outlook for real GDP since 1993. But look at the consensus is 0.3, but look at the range. The average of the top 10 at 1.3 and the average of the bottom 10, negative 0.5. That's a fairly wide range, but still their accuracy is less than 50%. So this is why one of the questions that a buddy and I were talking about recently is, does the recessionary label even matter? And I would argue no, not certainly for what I do for a living. We'll talk a little bit about that. But last year, we also talked about the term stagflation. This is the conclusion that I drew last year is still my conclusion. I don't know that we're going to see a recession in 2023, but I would contend that we are more likely in a longer term stagflationary environment. And stagflation is just a term that describes weak economic growth in a period of higher, relatively high inflation. Now, inflation, we didn't talk a lot about that today. I think that drum has been beaten. Inflation is starting to come down, but I think it was just this morning, over in England, they got a surprise on their inflation. Their inflation came in at year over year at 10.4, and I think they were expecting something less than 9. So I will not be surprised if the Federal Reserve does indeed continue to raise rates later today. I wouldn't be surprised if they lowered it instead of 50 basis points, that they only do 25 basis points. And I think it was last week that the European Central Bank went ahead and raised rates by another 50 basis points, despite everything that's going on in the purported banking crisis. So again, we'll see what happens at 2 o'clock, but that's my contention, is that we won't necessarily see a recession this year, but we're likely in more of a longer term stagflationary environment. Again, I shared this chart last year. This is arguably one of my favorite slides. This shows the S&P 500 from 1965 through 1979. And again, the stock market is not the same thing as the economy. There's a lot of correlation there, but it is not a one-to-one correlation. But if we have volatility like you saw and like you see in this chart, that doesn't suggest that there was strong economic activity during this time period. And again, if you know your history, you know it wasn't strong economic activity. And so there's you add a couple of recessions into that mix. And one of the points that I made last year was one of the problems I think that we have in today's environment is that most folks don't really remember this, because if I'm just going to guess on the average age of the attendees for our session today, I would guess that you were between ages of 6 and 20 years old when we were going through this type of crisis. So you don't remember this. But now you're charged with leading an organization or influencing an organization in a time period that's probably very similar to this. And if you study the history of the United States, what ends up happening sometimes is a period like this 15-year time period gets lost in the 100-year history. Okay. And I remember several years ago, there was a stat from an organization, and it said something like the US stock market on average generates a return of 5.7% over the last 100 years. I don't remember the stat. Don't write that down. That's not a polling question because I'm not sure if it's 100% the number what it was. But the point was that the math was true, but it's 100% irrelevant because nobody has a 100-year time horizon. And so we have to think about this 15-year time period. If we're going to go through a period like this, and you're leading an organization, that's a really challenging 15-year time period in your career. Now, if we add on top of that the effects of inflation, that is that same time period, 1965 through 1979, but adjusted for inflation. And you can see that is not a positive trend. And we can actually add 2 more years because this trend didn't really correct until 1982. That is a really long time period. And I'm not suggesting that we're in for an economic crisis that is that long in duration. But when I look at the data, I don't see a bunch of flashing red lights that saying recession is coming, recession is coming, recession is coming. That said, I also don't see robust growth. So we'll see what happens. And we'll begin to land the plane here. This is, someone shared this with me many years ago, that if you laid all the world's economists end to end, you would not reach a conclusion. So I'll try not to do that and try to come up with some conclusions. And I've already stated this. We may not see a recession in 2023, but it seems reasonable to conclude that we may very well be in a longer term stagflationary environment. And my recommendation for individuals would be the same as it would be if I'm talking to a CFO or a controller or somebody that's has influence over a corporate budget. I would tell you to maintain strong cash reserves. I would tell you to pay off any variable rate debt. I would trim the fat. That goes back to what Crystal was saying in terms of laying off potential some of the workers. And then I would say grow with wisdom. That doesn't mean Amazon should not continue to grow if they try to trim some of their fat, but just grow wisely. So that's that. So we'll begin to wrap up here, and you can open it up for some Q&A. I got to throw my QR code back up, as well as the disclosure that says everything I just said might indeed be wrong. Again, if you feel free to contact me through the QR code, you can find us on all the various social media channels. Feel free to reach out if you have a specific question. I also, if the ladies wouldn't mind, put up a shameless plug. I am once again going to be I've created a cycling team to participate in the V Foundation's Victory Ride to Cure Cancer. So if cancer research is important to you, I'd love it if you navigated over there and helped our team raise a little bit of money. And then there's our YouTube channel. And then I think that is it. So 12:51. How's that for timing?
Oh, you can't get any better than that.
Well, maybe one more minute. So we can stop and see if anybody has any questions, or if everybody's already made a run to get that afternoon cup of coffee. And
yeah, perfect. There's a couple of comments in the chat here. I think Mark, I'm sorry, made a comment a few slides back that I didn't see in there. Then he went on to just mention studies showing the real rate of return in the market, 6.7, which is
that's probably right. Yeah.
Okay, and then Jane does have a question. What do you think the role of social media is on people's perception, if not reality?
That's a great question, Jane. I think I think in general, one of the challenges of social media is there's 2 aspects of social media. One is people that are using it from a social perspective, if you will. They're just like some of my colleagues that I interact with on a regular basis. I've never met them. I've got a friend in Ohio I've never met. I've now regularly converse with a colleague in Charlotte and one in New York City. And it's nice because you're collaborating. So from that angle, social media is very helpful. Sometimes the challenge is people feel like they got to bang their own gong, and they're saying things that are very declarative, like that Bloomberg article that I showed you that was published on October 17th. 100% chance. I don't know what the right word to, but that's pretty dangerous to say stuff like that. And I think that's one of the challenges is when people feel like they have to make a name for themselves, since they have to be bold and say something very declarative, very certain to happen. But when you look at the data doesn't suggest that we're in for a recession. Again, I'm not suggesting that our economy is going to grow robustly. And remember, one of the things that we talked about that is recessionary is that yield curve. The yield curve's inversion doesn't invert a perfect 6 months before recession starts or a perfect 2 months before recession starts. The lag time varies widely. So that yield curve inversion that we were talking about early on the presentation very well may be forecasting recession, but maybe the recession is not until 2024. And so again, if there's, the recommendation was to, monitor your cash, make sure we're not trying to grow too quickly and spending down cash. Let's be careful because we don't know what's going to happen. And some of the geopolitical risks that are out there are big risks. So hope that answered the question. Good question, Jane. Are there any other questions?
Any other questions? Drop them in now. This will give everybody that 5 minutes. I learned that from one of our speakers, that you try to end it with 5 minutes before the next meeting picking up, so everybody has that little bit of buffer time. So we will go ahead and close out and thank Ted for his time. And I'm one of these, I enjoy batting back and forth, talking about the economy and housing and job market and what's coming next. So I always like looking at data sets and trying to interpret them. So appreciate you coming out and sharing that with us. For all the other participants, I will email out your certificates next week. Just make sure that you do add your name to it and then print it out and keep it for your file. We do have another event scheduled for April 18th. It'll be a lunchtime session similar to this virtually. So April 18th, I will send that invite out probably next week. But if you want to go ahead and mark your calendar now, that'd be fantastic. So hope everybody has a wonderful day, and we will see you on the 18th, if not before then. Again, thank you so much, Ted.
Thank you for having me.